Global politics have a profound impact on financial markets, influencing everything from stock prices to currency exchange rates. Understanding how geopolitical events shape the investment landscape can help you make more informed decisions and navigate potential risks. Here's a deep dive into how global politics affect your investments and what trends to watch. 1. Trade wars and tariffs impact on markets. Trade disputes between major economies, such as the US and China, can lead to increased tariffs and trade barriers. These actions can disrupt global supply chains, leading to increased costs for businesses and affecting their profitability. Investment considerations. Companies heavily involved in international trade or those that rely on imported goods may see their stock prices fluctuate due to trade tensions. Investors should keep an eye on industries like technology, manufacturing, and agriculture, which are particularly vulnerable to trade policy changes. 2. Political instability. Economic consequences. Political instability, whether from elections, civil unrest, or government changes, can create uncertainty in financial markets. Investors often react to political instability by moving their money to safer assets, such as gold or government bonds, leading to volatility in the stock market. Investment considerations. Countries experiencing political turmoil may see their currencies devalue, affecting foreign investments. Investors should be cautious when investing in regions with high political risk and consider diversifying their portfolios to mitigate potential losses. 3. Regulatory changes. Shifts in policy. Governments around the world continuously introduce new regulations that can affect various industries. For example, environmental regulations can impact energy companies, while financial regulations can influence banks and financial institutions. Investment considerations. Regulatory changes can create both challenges and opportunities for businesses. Investors should stay informed about potential regulatory shifts in sectors they are invested in and consider how these changes might impact future profitability. 4. International sanctions. Economic isolation. Sanctions imposed by one country on another can restrict trade, limit access to financial markets, and isolate targeted economies from global commerce. These sanctions can have significant economic repercussions, both for the country being sanctioned and for companies doing business with it. Investment considerations. Investors with exposure to regions or companies facing sanctions should assess the potential risks and consider the long-term implications of these measures. Sanctions can lead to reduced revenues and increased costs for affected businesses. 5. Global alliances and trade agreements. Economic integration. Trade agreements and global alliances, such as the European Union, EU, or the North American Free Trade Agreement, NAFTA, facilitate economic cooperation and integration between member states. These agreements often reduce tariffs and trade barriers, boosting economic activity. Investment considerations. Positive trade relations and strong alliances can benefit companies involved in international trade, leading to increased market access and lower operational costs. Investors should monitor developments in trade agreements to identify potential investment opportunities. 6. Currency fluctuations. Exchange rate volatility. Political events often lead to fluctuations in currency exchange rates, affecting the value of investments denominated in foreign currencies. For instance, political instability in a country can cause its currency to depreciate, impacting investors holding assets in that currency. Investment considerations. Investors should be mindful of currency risk when investing in foreign markets. Diversifying across different currencies or using hedging strategies can help mitigate the impact of currency fluctuations on investment returns. 7. Economic sanctions and embargoes. Restrictions on trade. Economic sanctions and embargoes are tools used by governments to exert pressure on other nations by limiting trade and financial transactions. These measures can have a significant impact on global markets, particularly in industries like energy, finance, and defense. Investment considerations: investors should be aware of any sanctions or embargoes that might affect their investments, especially in sectors reliant on international trade. Monitoring geopolitical developments can help anticipate potential risks and adjust investment strategies accordingly. 8. Global economic policies. Fiscal and monetary policies. Government decisions on fiscal policy, taxing and spending, and monetary policy, control of the money supply, can influence economic growth, inflation, and interest rates. These policies are often shaped by global political considerations. Investment considerations: investors should track economic policies in key markets to understand their potential impact on inflation, interest rates, and economic growth. These factors can influence the performance of various asset classes, including stocks, bonds, and real estate. 9. Geopolitical tensions. Conflict and market reactions. Geopolitical tensions, such as military conflicts or diplomatic disputes, can lead to market volatility. Investors often seek safer assets during times of geopolitical uncertainty, leading to fluctuations in commodity prices and stock markets. Investment considerations: while geopolitical events are often unpredictable, investors can mitigate risks by diversifying their portfolios across different regions and asset classes. Keeping an eye on global news and understanding the potential implications of geopolitical tensions can help in making timely investment decisions. 10. Environmental and climate policies. Global climate initiatives. Climate change and environmental sustainability are increasingly influencing global politics, leading to new regulations and policies aimed at reducing carbon emissions and promoting clean energy. Investment considerations: investors should consider the impact of climate policies on industries such as energy, transportation, and manufacturing. Companies that are proactive in adopting sustainable practices may benefit from these policies, while those lagging behind could face increased regulatory pressure. Global politics and economic policies are deeply interconnected, and understanding this connection is vital for investors seeking to navigate the complexities of international markets. In recent years, we've seen how global economic policies, driven by political decisions, have had significant effects on investment strategies and outcomes. Here's a closer look at how these policies shape the financial landscape and what investors need to consider. Monetary policy and central banks' influence on interest rates. Central banks play a critical role in setting interest rates, which directly impact borrowing costs, consumer spending, and investment. For instance, when a central bank decides to lower interest rates, it often leads to increased borrowing and spending, which can stimulate economic growth. Conversely, raising rates can slow down inflation but might also dampen economic activity. Investment considerations: investors should monitor central bank announcements and understand how changes in interest rates might affect their portfolios. For example, lower interest rates can benefit sectors like real estate and consumer goods, while higher rates might make bonds more attractive compared to stocks. Fiscal policy and government spending impact on economic growth. Fiscal policies, including government spending and taxation, are tools used by governments to influence economic growth. Expansionary fiscal policies, such as increased government spending or tax cuts, can boost economic activity and create opportunities for businesses and investors. Investment considerations: investors should consider how government spending priorities might affect different sectors. For instance, increased spending on infrastructure can benefit construction and industrial companies, while tax cuts might boost consumer spending and positively impact retail stocks. Trade policies and global supply chains. Shaping global trade. Trade policies, including tariffs, trade agreements, and import/export regulations can have profound effects on global supply chains and international trade. These policies are often influenced by political considerations and can create opportunities or challenges for businesses engaged in global trade. Investment considerations: investors need to stay informed about trade negotiations and policies that might impact the industries they are invested in. For example, tariffs on imported goods can increase costs for companies relying on foreign suppliers, potentially affecting their profitability and stock prices. Currency manipulation and exchange rates: geopolitical influence on currencies. Governments sometimes engage in currency manipulation to gain a competitive advantage in international trade. By devaluing their currency, a country can make its exports cheaper and more attractive to foreign buyers, but this can lead to tensions with trading partners. Investment considerations: currency fluctuations can significantly impact investments, especially those in foreign markets. Investors should consider hedging strategies to protect against adverse currency movements and be aware of how geopolitical events might influence exchange rates. Environmental policies and green investments: global push for sustainability. Environmental policies, driven by global climate agreements and national regulations, are increasingly shaping investment decisions. Governments worldwide are implementing policies to reduce carbon emissions, promote renewable energy, and encourage sustainable business practices. Investment considerations: investors should consider the growing trend of green investments and how environmental policies might impact different sectors. Companies that are leaders in sustainability are likely to benefit from these policies, while those that are slow to adapt may face regulatory challenges and increased costs. Geopolitical risks and market volatility. Political uncertainty: geopolitical risks, such as conflicts, elections, and diplomatic disputes, can create uncertainty in financial markets. Investors often react to geopolitical events by moving their money into safer assets, leading to increased volatility. Investment considerations: diversification is key to managing geopolitical risks. By spreading investments across different regions and asset classes, investors can reduce their exposure to any single geopolitical event. Staying informed about global political developments and understanding their potential impact on markets is also crucial for making informed investment decisions. Global economic policies and trade agreements shaping the future of trade. Trade agreements and economic policies set the framework for international trade and economic cooperation. These policies can open up new markets, create opportunities for businesses, and drive economic growth. Investment considerations: investors should pay attention to trade agreements and policies that might create new opportunities or challenges for the industries they are invested in. For example, a new trade agreement between major economies could open up new markets for companies, leading to increased revenues and stock price appreciation. Government debt and fiscal responsibility impact on economic stability. High levels of government debt can lead to concerns about fiscal responsibility and economic stability. Countries with significant debt burdens may face challenges in financing their operations, leading to potential austerity measures or inflationary pressures. Investment considerations: investors should consider the fiscal health of the countries they are investing in. High levels of government debt can lead to increased borrowing costs, reduced government spending, and potential economic instability, all of which can impact investment returns. Tax policies and corporate profits influence on business decisions. Tax policies play a critical role in shaping business decisions and profitability. Changes in corporate tax rates, capital gains taxes, and other tax regulations can have significant effects on companies' bottom lines and investment returns. Investment considerations: investors should stay informed about potential changes in tax policies and how they might impact the industries and companies they are invested in. Understanding the tax landscape can help investors make more informed decisions and potentially capitalize on tax-related opportunities. Understanding the impact of global politics on your investments requires a deeper look into the ever-changing geopolitical landscape and how it influences markets. Here are some additional factors to consider: emerging markets and political stability. Volatility in emerging economies. Emerging markets often present high growth potential, but they also come with increased political risks. Political instability, corruption, and government intervention can lead to market volatility, affecting investments in these regions. Investment considerations. When investing in emerging markets, it's essential to evaluate the political climate and potential risks. Diversification across different emerging economies and sectors can help mitigate these risks. Additionally, keeping an eye on global political events that could influence these markets is crucial. Sanctions and their economic impacts. Weaponizing economics. Sanctions are a powerful tool used by governments to exert economic pressure on other nations. These can range from trade restrictions to asset freezes and can significantly impact the economies of both the target and the imposing country. Investment considerations. Sanctions can create opportunities and challenges. Companies that find ways to navigate sanctions or benefit from them can see increased profitability. However, investments in countries or companies affected by sanctions may experience losses. Staying informed about current and potential sanctions is key to managing these risks. Global health crises and economic disruption. Pandemics and economic shocks. Global health crises, such as pandemics, can disrupt economies on an unprecedented scale. These events often lead to supply chain disruptions, changes in consumer behavior, and shifts in global trade patterns. Investment considerations. Investors should consider the potential for global health crises to impact markets. Companies in the healthcare sector may see growth opportunities, while others might face significant challenges. Diversifying investments and including sectors that are more resilient to such crises can help protect against these risks. Technological advancements and global competition. Tech wars and innovation. As technology becomes a central pillar of global competition, countries are increasingly focusing on innovation to gain an economic edge. This has led to tech wars, where nations compete for dominance in areas like artificial intelligence, 5G, and cybersecurity. Investment considerations. Investors should be aware of how global competition in technology might impact their portfolios. Companies leading in innovation or benefiting from government support in their home countries may offer significant growth opportunities. Conversely, companies in countries facing tech-related sanctions or restrictions might experience setbacks. International alliances and economic cooperation. Shaping global trade and investment. International alliances, such as the European Union, ASEAN, and the Trans-Pacific Partnership, play a critical role in shaping global trade and investment. These alliances can create opportunities for cross-border investments, reduce trade barriers, and promote economic cooperation. Investment considerations. Investors should monitor the developments within international alliances and understand how they might influence global trade and investment flows. Countries and companies that are part of strong alliances may benefit from increased trade opportunities and economic stability, while those outside these alliances might face higher barriers to trade and investment. Environmental policies and global climate agreements. Green investments and sustainability. Global climate agreements, such as the Paris Agreement, are driving significant changes in environmental policies worldwide. These policies are encouraging investments in renewable energy, sustainable practices, and green technologies. Investment considerations. Investors should consider incorporating green investments into their portfolios to take advantage of the growing emphasis on sustainability. Companies that align with global environmental goals are likely to benefit from favorable regulations, while those that don't may face increased costs and regulatory challenges. By understanding these additional factors and their implications, you can better navigate the complexities of global politics and make informed investment decisions. Stay tuned to this channel for more in-depth analysis and strategies to help you succeed in the ever-changing world of finance. If you found this video helpful, don't forget to subscribe to the channel and hit the like button. Your support helps us bring you more valuable content to enhance your financial knowledge.